Okay, good morning guys. This is the next video on chapter 11. This will be the part 1, and I would use this as a supplement to the lecture classes and when you start working on some of the homework problems. Okay, so part 1 of capital budgeting. So in this chapter we're going to be looking at methods to determine a couple things. Project or projects you want to invest in. So for example, if we have project A that will cost X number of dollars and deliver certain cash flows, and we have project B that will cost X number of dollars and also have certain different cash flows, we want to determine which one we should pick. So for example, your boss may ask you to run the numbers for project A and project B and tell him which one we should pick. So there are a couple of methods that are currently used to determine that in terms of capital budgeting. The ones we're going to go over are, there are 5 different methods: NPV, IRR, MIRR, the payback, or commonly referred to as a break-even point, and the last is a discount payback. Okay, so we'll go through each one individually. Let's just, before we get into those, just to define a couple of terms. As we've done in the other chapters, we're going to be using cost of capital. That's going to function exactly the way interest rate, when we have an interest rate that we compound or discount. In this exercise, when we look at NPV and different methods of projecting what something might cost or what it may return, we're going to use something cost of capital. Okay? So the first method, NPV, which you guys have learned about from the various chapters, this is actually the most widely accepted method of determining between project A and project B, which one we should accept. Okay? And essentially, if the numbers turn out to be positive, we can accept it. If the numbers are negative, then you would reject that project. So that's the basic criteria using NPV. Now, with all these methods at play, there's something we need to look at. First is the project independent or is it mutually exclusive? And really what that means is, if the project is considered independent, that means we can actually pick both projects if the value is positive. So for example, if you have a project going on in New York and you have a second project under your company happening in Chicago, and your boss may ask you to run the numbers and see if those numbers are positive, if the NPV is positive. If they are both good, then you can pick, and it's classified as independent. That means you can actually pick both project A and project B if the net present value is a positive number. Now, also, if they're negative, you could reject both. If project A is positive, project B is negative, then of course you would only pick the one that's positive. But in summary, if they're both a positive NPV and they're classified as independent, we can choose both projects. On the other hand, if they're classified as mutually exclusive, they're exclusive to one another. So if they both are positive, generally what happens is we pick the one with the higher net present value. If they're both negative, you can reject both, okay? But we can't pick, if it's mutually exclusive, you can only pick one, okay? Second method, internal rate of return. We've gone over this in previous chapters, and so that the principle doesn't change. Essentially, we have a timeline. Here we have laid out $1,000, and the first cash flow we're getting is 500, second 400, next 300, and the last cash flow is 100. So we work it the same way that we've done in the past. The only difference is we may see something called cost of capital. Okay, so cost of capital refers to this amount. So if we've embarked on a project and we've purchased $1,000 of material, that's the cost of capital. And so it costs us 10% to front the project, and we're getting these outflows. Okay. If you run the numbers and your internal rate of return is greater than 10%, in this case, it's greater than the cost of capital, then we can accept it. And again, the mutually exclusive independent applies to this as well. So if it's classified as independent and we're looking at two projects, we can accept both if the IRR is greater than cost of capital. Okay? Okay, the next one, this is the one that's probably we need to work on in class and work some problems, discuss it in detail, because we haven't really done this too much. Again, we've done the NPV, we've worked with internal rate of return. This is essentially, it's MIRR, it's modifying the internal rate of return equation. So, if we have the same numbers, okay, we laid out $1,000, we're getting these cash flows coming in at year 1, 2, 3, and 4. Cost of capital is 10%. What we have to do is a couple of terminology, define a couple of things first. That $1,000 is your present value. This ending when the project ends, okay, that's called the TV, the terminal value. So when the project ends at the 4th year, that's called the terminal value. So what we have to do, there are a couple steps. A couple steps to find the modified internal rate of return. Okay, first is we have to find all the future values at year 4, which happen to be the terminal value. Okay, so that's step 1, and we have to take, let me go back to the other one for a second. Okay, so in this case, we want to take 500, find the future value at this point, get that number. Get 400, take the future value and come up with some number. 300, take the future value and come up with some number. And this last value of 100, that's when the project ends, so that has no future value other than 100. Okay, so when we get the future value of all those amounts, okay, we add them up at the terminal value, okay, and then we set up an equation. That's now our future value, the things we've done, all semester. Okay, so here's the timeline. So we have to do these individually because, again, remember your calculator is not equipped, is not set up to find future values. It's only set up to find present values. So we have to do a couple things as a workaround. So 500, the future value of that is 665.50. So it's 1, 2, 3 periods at 10%, okay? And that gives us 665. We set up another equation. We want to look for 400, the future value of 400 for 2 periods at 10%, the cost of capital. That gets us to 484. 300, same thing, that will get us to 330. Again, 100 ends at the terminal value, the end of the project. So we add all these amounts, and that gives us an amount of $1,579. That's about 10 minutes. Let me stop here, and then we'll start back with part 2.